Okay, so as we discuss this chapter, this concept of accounting for merchandising businesses, just want to give you a little bit of insight. We've discussed so far the journalizing process, and we've talked about making adjusting entries. And so if we had an adjusted trial balance. But before that, we had an unadjusted trial balance. And then ultimately, after the closing process, we had a post-closing trial balance. Um, and we talked about posting journal entries to the general ledger in so much as it was a part of the accounting cycle. But we really just touched on it. So let's go over these points really quick. It says all businesses have a general ledger, not just merchandising businesses. Okay, and I bring that up only because, again, this is a true statement, and we haven't really discussed the general ledger in any kind of depth so far. All right, it says that the general budget lists all accounts and account balances for each. Okay, so with that in mind, that it lists all accounts, the order is identical to the chart of accounts and the trial balance. Okay, now here's where things start to change up a little bit. The chart of accounts lists all accounts no matter what, and so does the general ledger. However, it says a dollar amount is included for each account. Okay, so we can look at our chart of accounts, and if we have 200 accounts in our chart of accounts, we can be absolutely guaranteed that these same 200 accounts are in our general ledger. Okay? Now, last point. Unlike the trial balance, however, the general ledger lists all accounts, even zero balance accounts. All right, so if you noticed a moment ago, I said there might be 200 accounts in the chart of accounts. That would be no big deal whatsoever. Even 300 accounts in the chart of accounts. That would be for a pretty small business. Okay, but a lot of these accounts, we might borrow some money and we set up an account for a specific note payable. And then we paid that off, 2 years ago. Well, that doesn't mean that we're necessarily going to go in and delete that right away. So this chart of accounts and general ledger can be pretty big. The trial balance, as you recall, at least in our examples, always would fit on one piece of paper. And I can tell you from professional experience that a trial balance is usually about 2 pages. The general ledger, not exactly the same situation. Even a concise general ledger is probably going to be 6 to 8 pages long. Okay, and if we put each individual transaction that takes place over the course of the year, it can be very, very long. Okay, so that's a little bit of information about the general ledger, just what it is. That would fall into the category of something that is similar between merchandising and service businesses. We do need to get into this idea of controlling accounts, and this is also something, it's included in your chapter for merchandising businesses, but it is just as relevant to a service-related business also. So, controlling accounts. Well, good news. You already know a little bit about controlling accounts, and that's because those are really the only types of accounts that you have dealt with. So it says here, typical controlling accounts are accounts payable and accounts receivable. So, think about the examples that we've had so far. We've looked at accounts receivable. Say, for example, you've done some exercises, and we've said that accounts receivable were $150,000, or that accounts payable was $25,000. But then let's look at this third bullet point. It says, but how do we know who owes us money or to whom we owe money, right? That $150,000 in accounts receivable that you may have seen in one of your exercises is not owed to that company from one client, usually. That $150,000 may be owed by say 50 or 60 different clients, and that $25,000 in accounts payable that we owe might be to 6, 7, 8 vendors. You see what I mean? So the controlling account is the accounts payable and the accounts receivable, but in order to keep our books truly correct at all times, we have to break things down a little bit more than that. And that's whenever we get into this idea of subsidiary accounts. And it says here, a subsidiary account is used to track information at a very detailed level for certain types of transactions, such as the two that we've already mentioned. Okay, and we're going to get into some examples of that. So just think about this. If you were to send in your phone bill, or the payment for your phone bill, if you, and most of you probably would not do that through the mail, you would just get online and pay your bill. Well, let's think about it. When you log in, you're going to have a customer number that's associated with your cell phone bill, right? And probably would have your phone number on there. Well, that is a subsidiary account. Okay, so let's say that you have service through T-Mobile or AT&T, whoever it is. Their total accounts payable, because they're a service-related business, is going to be millions and millions and millions and millions of dollars. Okay, but there has to be a method so that when you pay your bill of $131.86, that $131.86 comes off the total accounts receivable for Sprint or T-Mobile, whoever, and it also comes off of your personal balance. So that's what we're talking about when we talk about subsidiary accounts. Now, in this particular chapter, our examples are going to revolve around merchandise and inventory, because that's what the chapter is about. But I use the cell phone bill example because that's something that you can probably relate to. Okay, so before we do get into too much into inventory, we're going to actually have an entire chapter on inventory a little bit later. But we do want to at least mention right now that there are two systems for keeping track of inventory, and they are the periodic and the perpetual inventory systems. And the difference between these two, what you will see out in the world most often is the perpetual inventory system. And this is a system where, let's say that you go to Walmart and you buy a pair of flip-flops, for the summertime. And they have 16 pairs of a certain design of flip-flops in whatever size you wear. What did I say, 16 pairs? And then the cashier, he or she scans your that pair of flip-flops, and you pay. And as soon as you pay, the inventory system for that particular item goes from 16 in stock to 15 in stock. Okay, so you add the detailed inventory records as Walmart purchases the goods for sale, and then each time one of those items is sold, it subtracts it from the inventory. A periodic inventory system is different. This is more old school. This is the way that businesses used to do things. I call it eyeballing. Orders are made based on what we see we need and so forth. And then at the end of the year or so, we'll go through and we will say, okay, well, you know what? I started off with 10 of these, and then I bought 50 of them, and now I have 20 of them. So that must mean I sold 40. So when we go back to the cost of goods formula, okay, and I don't like to say this, but it is the truth. The cost of goods sold formula is a periodic inventory formula, okay, at its roots. So I say that, and I tell you that cost of goods sold is on the income statement for a retailer, and then I tell you that we use the perpetual inventory system. Okay, but I do want you to understand that there are these two different types of inventory system, and that the perpetual inventory system is the most common. Again, we're going to get into inventory systems in much more detail later in the course. So here we have an example of a typical journal entry. It says under the perpetual inventory system, cash purchases of merchandise are recorded as follows. So this would be, say for example, if Walmart bought those flip-flops from a company called Bowen. Now they're going to probably, it's this inventory here, this is really general and vague here, but again, this is an introductory level class, so maybe they probably wouldn't be buying these on January the 3rd. Maybe we should use a different example other than flip-flops. But anyway, we've purchased inventory here. Inventory, if you look at your cheat sheet, is most definitely an asset. So the inventory has gone up. So it's over here to the left, $2,510. We paid cash for this inventory. So assets go down with a credit. That's why cash is over here to the right for the same $2,510. Okay. Now we have a little bit different example for purchase transactions. This is a purchase of merchandise on account, and this is how we would record it. Okay, so the entry to inventory is going to be the exact same. The inventory, since we're purchasing inventory, the asset is going up, in this case for $9,250. Okay, but we need to know two things. For our balance sheet presentation, we need to acknowledge that we owe $9,250. Okay, so that's going to show up on our balance sheet as accounts payable. But we're going to have a subsidiary account for this vendor, because this is who we purchased the inventory from, Thomas Corporation. So accounts payable is the controlling account. Thomas Corporation is the subsidiary account. That way, when we pay this bill, not only does accounts payable go down by $9,250, but so does our debt specifically to Thomas Corporation. And of course, we expect them to do the same thing on the other end of this transaction. Okay, let's see. Do we really want to get into this? Let's go ahead and stop this video here at purchase transactions, and then we're going to get into what we call purchase discounts in the next video.